All right, folks, we're going back here to the Diagnostic Trading Hour. And we're just going through, we're looking at the news and going through the plans put them together. We were talking about checking out a potential natural gas trade over here as well. So I want to get that set up for you. Give me 1 second. We'll bring all that up, close out some of these other charts from earlier in the show, and open that chart on up for you. Let's see. Let me get a different one. There we go. All right. Let's change this one up to natural gas. And all right, so on natural gas, it's taking me just a second. There we go. One of the trades we were looking at over here was the ability to basically trade off of the natural gas oil inventory report. And let's see here. Trying to grab the stupid screen. There we go. Come on. Let me have it. Not responding. A little technical difficulty here. Maybe if I can close it down. All right. I'm going to copy it. I'm going to open it in a different browser. All right, there we go. That some shockwave flash load issues was causing the problem. Okay. So looking at this is an article put together about different ways to trade the natural gas inventory reports. Every Thursday morning, the report comes out. Just about every Thursday, unless there's a holiday or something like that, comes out. It's released. If the inventory is higher than expected, then the gas market would theoretically usually drop, and if the report is lower than expected, it usually would rise in price. Things don't always go according to fundamentals, but that is at least the general expectation. And I was talking there's a few ways to trade the report. And so I want to go through a few of those ways with you while we're looking over a natural gas chart. And that's why I'm just trying to get that one up for you. All right, there we go. Got it loaded. And so the ways I was looking at it is, one, of course, I always use my deviation levels on any trade that I do. And I want to make sure that I'm on the right contracts, at the right months. And the report's going to come out at 10:30, so you can have something like Forex Factory or something like that opened whenever you're going to place the trade. And you can look at the binaries, you can look at the spreads. There's, like I said, there's multiple ways you can trade this report, but it can have some pretty big moves. One of the biggest things about these moves is you want to make sure that you are looking at proper expectations. So let's go ahead and let's add in expected ranges over here. With those expected ranges being added in. All right. So now we can zoom in a little bit tighter on it. Like I said, a few ways to trade it. So you can use, magnet volume price levels. So, and that, basically that's sort of, plotting it going towards the expected channel there. And it's made its move. So you can look at volume, you can look at 5-minute, you can look at 10-minute, you can look at 15-minute levels on 5-minute charts. You go through, just pull all those up. You can also pull up, spike strikers, which is one of my favorite ways to look at things after a news trade. And often on this trade, you may want to be looking at, potentially looking at using, Nadex like daily binary contracts. So let's sort of try to shrink this down a little bit. I know there's a lot of text going on there. And, we'll shrink quite a few things. Let's just bring it on down here. And I'll make the text a little bit smaller, just the way these are plotted. Be a little bit difficult for you to see out there. So let's try 12. See if that gets it a little bit more legible. Yeah, that's a lot better. Okay, so anyways, volume spikes on up, and then we get a short sell. You could do a short sell going into end of hour in the money. That would have been profitable, and that would have been a current hour expiration. That would have been a 12 o'clock expiration. Okay, and that would have been an in-the-money contract. Another trade setup you could have done could have been you could have done an at-the-money expiration, which would have also, expired in the money, like say for the following hour. Another possible trade is targeting down to, like, let's say the 0.5 deviation level, going right back down to pretty much where it was before it started, as of the expiration right there, and looking at that as a potential out-of-the-money trade. Okay? So, first thing is we're going to set up a chart. We can look at 5, we can look at 5, 10, 15, we can look at whatever. I'll just put it on 5. Make it simpler. It makes the charts a little cleaner for seeing the entries there. And so again, one of your choices may be to go in, and I don't talk about this a lot, but looking at your daily binaries versus your intraday binaries. Let price move up or down, ideally by at least a deviation. It doesn't always, not necessarily always going to move that full deviation. Let's see, what do we get high to low today? Let's check on the high to low deviation marker. Got pretty high. Ideally, just at least to hit a new deviation level. But maybe, a deviation move. On that, often we don't get a full deviation move on a natural gas report, so you wouldn't want to necessarily require that. But it's approximately about a deviation move. It's pretty close to it, so maybe about 0.7 of a deviation move. Look at that channel. Use it to target your out-of-the-money strikes on your channel borders. So the idea here being to go in, and it flies up, and then what you do is you pick the end-of-day expiration, like 2:30, and you target this border right here, okay? And so you're targeting 36.07. You look for a binary strike at that price level. Since you have one at that price level, then what we can do is we can go in and go, okay, well, what was the price? What was it valued at? So let me log on just to the Nadex demo platform. Has something that the live one doesn't have yet. Their charts are working on the actual binary pricing. So let's pull that up real quick and look at it. We got indices, or not indices, we got commodity binaries, we got natural gas, we got daily. Okay, so I'm right here inside the Nadex platform. And what are we targeting? Around 36.07. So we got the daily contracts. So go here to 36, 20. And let's look at the quick chart. Quick chart ought to show us the actual binary contract itself. We have to zoom out a little bit here. Let's make it give us less time, more time. See if we get this thing to fix. I know they're working on these little charts. These are new charts they're adding in. They're trying to plot the binaries out, and they aren't exactly the most astute at doing so. Am I right on my price? Let me make sure on that. 3,600. Oh, 3,600. Oh, 3,620, 3,600, yeah. I think it's plotting like right at 70. Let me try that quick chart one more time. Yeah, it's just having an issue. Unfortunately, I wanted to show you the price. To give you an idea, we were up at, let's see, how far were we above this price? We were about 40 ticks higher, okay? And at 40 ticks higher, there's 40 ticks between these. So just to use the price ladder model, that would be, the sell would be right around $90, maybe a little bit higher. Because it was a little earlier in the time, right around the expiration, so maybe, 80. So, $80 sell, you could buy it back right now for 60, and you would have taken profit on that trade. And that's basically just letting it take off and then targeting the retracement on back down. What would even add to your confidence to do so is right there near the top, you actually got a spike striker to go short. Okay? So, simple trade, pops up, and then target the bottom of the channel there. Now, you could go in a couple different ways. So if it flies up, if it flies down, let me see here. And let me show you this one. Okay, so this is an example. Basically, right here, you could have went up at sold. You could have sold like right outside the range. You could have done a butterfly. So you could have sold the 4160 daily expiration with a limit order of $30. You could have bought the 3920 daily expiration with the limit order of $70. And you can wait for the market to move to fill either order. So basically, if it just barely got to the top or barely got to the bottom, it would fill either one of those orders. A lot of times on the oscillation, you could get both hit as well, okay, which would be good. So that's a way to go in and butterfly the trade, along the way. And let's see here. I'm just trying to go through a few different ways you can trade this support. We got Spike Striker. We got, after it bounces up, it starts pulling back. Target, basically the retracement to the previous price. We have a butterfly set above and below, but it may take oscillation to get hit. You may only get hit on one side, okay? Sometimes you get both. Sometimes that implied volatility goes high, so high that you get both. Now, you also could go in and you could use the expected ranges on the hour for the report that it's released, for like at 10 a.m. To 11 a.m. and looking at maybe at a daily binary contract. At the beginning of the hour, look for strikes just outside the higher or the lower range and set that limit order. So, and then go in and set a take profit to buy it back. So if I sell it at 30, maybe buy it back at 6. If I, buy it at 70, whatever, then, sell it back at, a little bit, 94. Okay? So just simple, that's your butterfly. So it's buying down here, selling up here, and taking profit. So we got just, when it bounces up doing a pullback, we have doing a butterfly. We also have the Spike Striker report. So just going in on the volume spikes and doing the fade right there on the volume spike. And very simple. So those are a few easy ways to trade the trade. You also can even look for, and add one more way to that, you could look for a straddle. So if you can find a cheap enough straddle, that is also a possibility. Let's say you could get a $50 straddle. Maybe your tent's not even going to take profit. And let's say you buy one up there and you sell one down here. If it expires above one of those levels, you're going to make $50. If it costs you $25 to buy the upper one and maybe costs you $25 to sell the lower one. So, sell get at 75. So the biggest point I want to get to across on this, and props to Lori and Sherry and Cameron, everybody who has helped contribute on all these, is just think outside the box. You got options. They are called options for a reason, right? So check them out, look at them, think about, okay, what are different ways that I can take advantage of this? Because it's when you're just trading futures, which I love trading futures, but when you're just trading futures, you're basically buying or selling or spreading futures. Maybe you're adding options, but they have a lot of theta and they have less gamma and delta to them. When you're trading options, you can combine them with your futures. You can combine them with your Forex. You can even combine them with your ETFs. Even these Nadex spreads you combine, like US 500 with spiders. I don't know why you would. I don't think it's the best use of money. I think you're better off with ES. But if you wanted to, you could combine, their small cap 2000 with IWM, and you can combine their Wall Street 30 with the diamonds. There's a lot of ways you can combine things together to really reduce your risk and hedge your risk as a trader. And anyways, but I just thought that would be sort of a cool thing to share today. To, sort of looking over in detail, on that trade, specifically, and how it worked. But again, thanks to all the people that helped me put some of this stuff together.